everyone, welcome to JAIIBontips. Today we will learn the chapter number 3 of AFM, that is maintenance of cash or subsidiary books and LEDGER. So let's start the chapter. Let's start with understanding bookkeeping or accounting. This is the systematic recording of transactions with a view to ascertain the financial position of the business. Business transactions are when things of value like money or goods are exchanged, right? Bookkeeping or accounting is a way of keeping track of these transactions to understand how a business is doing financially. This is important for all kinds of businesses. Think of it like this. Imagine you have a special notebook where you write down every time you receive money or buy something for your business. This helps you know how much stuff you have, like things you own and money owed to you, how much you owe to others, whether you are making money or losing money, and if your business is in good shape or not. So it tracks all the money you owe and all the money you own. So the key idea is double entry bookkeeping system. According to this system, every business transaction has a twofold financial aspect, which means that it affects two accounts. One account to be debited and other credited with a like amount. This is the fundamental principle of double entry bookkeeping. So simply it means every transaction at least affects two accounts. One gets more money, like getting paid, and the other gives away money, like paying for something. This helps you keep everything balanced and organized. So bookkeeping is like keeping a detailed record of your business activities to understand how well it's going and what you owe and what you own. It's like a financial detective work that helps you know if your business is making a profit, how much you owe and own, and if your business is doing well overall. So let's understand what is journal. The primary records for the transaction is the journal. A journal is a chronological record of all the transactions, showing the debit and credit of the account as affected by the transactions. In accounting, a journal is like a special book where a company writes down all its financial actions in the order they happen. It's like a diary of money-related events. For each action, like spending money, getting paid, or buying something, the company notes down important details. The date, the types of account involved like cash or sales, the amounts of money going in or out, and a brief description of what happened. So the journal is the first place where all these actions are recorded. So first, we write down the journal entries, right? The journal is the first place where all these transactions are recorded. It's like the rough draft of the company's financial story. Afterward, these entries are organized and sorted into different categories in what we call the LEDGER. So first we write journal and the second one is LEDGER. Think of the LEDGER as the polished version of the journal. It's like taking all the messy notes from the journal and neatly putting them into folders like income, expenses, and so on. So, a journal is where a company jots down every money-related move they make. This helps them keep track of their financial history accurately, and then they use the general LEDGER to make sense of all these actions in an organized and structured way. Let's understand the different types of accounts. Different types of accounts are, first one is the personal account, and the second one is impersonal accounts. Personal account is further divided in natural personal accounts, artificial personal accounts, representative personal accounts. Impersonal account is further divided in real accounts, which is divided in tangible real accounts, intangible real accounts, and the nominal account. Right? So let's understand all the categories one by one. Personal account. These accounts pertain to entities with which the business interacts on a personal level, encompassing various categories. So the first category is natural personal account. These accounts correspond to individuals, reflecting their involvement in the business financial affairs. Examples include the proprietor's account for the business owner, supplier's account or customer's account. Like you can say the Ram's account, Ramesh account, Atul's account, etc. Right. Second one is artificial personal accounts. Artificial personal accounts encompass legally recognized entities that engage in business transactions like corporations, banks, insurance companies, clubs and firms all fall under this category. Accounts for these entities are established to document their financial interactions. Third one is representative personal accounts. This category involves consolidating accounts of multiple individuals or entities which share characteristics. Rather than maintaining separate accounts for each party, transactions involving multiple stakeholders are aggregated under a common title. An example could be a rent outstanding account, representing various property owners owed rent. Second one is impersonal accounts. These accounts classify transactions and financial elements based on their nature, transcending individual entities. So the first one is real accounts, which is divided in tangible real account and intangible real accounts. So what are the tangible real accounts? As the name suggests, that all the tangible assets, properties and financial instruments encompass tangible real accounts. So these are the items that have a physical existence and hold value, like land, building, equipment, cash, etc. Okay. And the intangible real account, like there is no physical presence and there is the lack of physical presence but possess financial value, like intellectual property such as patents, trademarks, goodwill, etc. Right. And the last one is nominal account. Nominal accounts serve to categorize income, expenses, losses and gains. Remember, it's tell us about income, expenses like giving salary, giving rent, right? Losses and gains. Unlike personal and real accounts that involve specific entities or assets, nominal accounts serve a conceptual function. They provide insight into the financial performance and movement of funds within the business, like salary expenses, as I told you, rental payments, commission, interest income, anything. So, in a sense, while personal accounts involve transaction with individuals or entities, real and nominal account transcend individual transaction to categorize tangible and intangible assets, as well as financial activities. This structured classification facilitates comprehensive financial reporting, analysis and decision making at an advanced level of business understanding. I hope you understood this topic. So let's again understand everything with a small example. First one is the personal account. Natural personal account. Suppose you have a business owned by John. John's personal account would track all his interaction with the business, like investment he makes or withdrawals he takes from the business. Artificial personal account. Consider your business has an account with a bank. This bank account is like an artificial person because it is not an individual but an organization. You would have a bank account to track your dealings with the bank. Third one is representative personal account. We saw a rent outstanding account in that example. So let's take that example again. Imagine your business rent offices spaces from different property owners. Instead of having separate accounts for each owner, you can group them together under rent outstanding account to track how much rent is owed to all the property owners collectively. Right. Next one is impersonal accounts. Real account, tangible real account. So let's say our business owns a building. The building is a tangible asset. So you would have a real account for it. Any changes in the building's value or transactions involving it would be recorded in real account. And the intangible real account is, suppose your business has acquired a patent for a unique invention. The patent does not exist physically, but it is valuable. You would create an intangible real account for the patent to keep track of its value and any transactions related to it. Last one is nominal account. So think about your business paying salaries to employees. You would have a salaries expense nominal account. When you pay salaries, the money goes out of the business and this account helps you record and track that expense. So in summary, personal accounts deal with individual or groups, real account track tangible and intangible assets, and nominal accounts classify different financial activities. So these examples illustrate how each type of account functions in a business financial records. Let's understand the most important topic of accounting. There are 3 fundamental rules of accounting. Let's understand all the rules one by one. These are based on the types of accounting we have learned earlier. Right? So let's understand all the rules. The first one is linked with personal account. It says debit the receiver and credit the giver. Note it down in your notebook and read it. So the first rule is debit the receiver and credit the giver. When it applies, it will apply on personal accounts. Rule number 2 is it is linked with real accounts. And it says debit what comes in, credit what goes out. If cash is coming in, then it will be debited. And if cash is going out, then it will be credited. Right? So all the events related to real accounts will apply the rule of debit what comes in, credit what goes out. Last rule is for the nominal accounts. It says debit all expenses and losses, credit all incomes and gains. Like if I paid salary, then salary is the expense for business, right? So it will be debited. Why? Because debit all expenses and losses. So learn all the 3 rules. It will help in your journal entries. Now let's see some examples. First one is machinery purchased on cash for rupees 12,000. Now machinery is the tangible asset, tangible real account, right? And cash is again tangible real account. Now tangible real account says debit what comes in, and credit what goes out. Remember? So machinery is coming in and cash is going out because we are purchasing the machinery. So machinery is coming in our business, right? And cash is going out from my business. So machinery account will be debited to cash account for rupees 12,000 each. Okay. Next one is income received in cash for rupees 15,000. Right? Again, the cash is tangible real account and income is nominal account. Right? Now nominal account says debit all the expenses and losses and credit all income and gains. Remember? So income is credited and cash is coming in, right? So cash will be debited because debit what goes out. So cash account will be debit to the income account for the rupees 15,000. Next one is rent paid rupees 50,000. Rent is again the nominal account. We are giving cash for rent, so cash will be going out, right? So rent account will be debited. Why? Because it is an expense, and in nominal account debit all expenses and losses, and cash is going out, so cash account will be credited because credit or what goes out, right? For rupees 50,000, right? I hope this is clear now. Let's understand some more examples. Fourth one is purchased goods on credit from XYZ traders worth rupees 1 lakh. Now goods are coming in, that means purchase account will be debited. Why? Because debit what comes in, credit what goes out. So goods are coming in, so it will be debited. And we are getting it from XYZ traders. And XYZ traders is personal account. Right? Now personal account is debit the receiver, credit the giver. And XYZ trader is giving the goods. Right? So we are getting this from XYZ traders. XYZ traders. Right? For rupees 1 lakh each. Next one is purchase furniture worth rupees 75,000. I hope this is easy for you. Just pause the video and try it on your own. What will be the answer? Purchased furniture worth rupees 75,000. Furniture is coming in our business. So it will be debited because debit what comes in. Right? And it is coming for worth rupees 75,000. That means cash is going out and cash will be credited. Right? I hope this is easy now. Just go to our channel now and solve as many questions as you can. There are many questions we are going to post there. So solve it. So the last topic is petty cash book. Petty cash book is one of the subsidiary books in which all the payments or petty expenses such as conveyance, cartage, etc. are recorded. Petty means small. Small in amounts. The person maintaining the petty cash book is known as the petty cashier. So let's understand it simply. It means in the operational course of a business, there are numerous minor expenditures that occur daily, right? These relatively inconsequential payments, often referred to as petty expenses, encompass a range of routine costs such as transportation fees, small supplies, and other incidental outlays. If each of these small transactions were to be recorded directly in the primary cash book, it would not only increase its size significantly but also render it unwidely and less efficient for financial analysis and reporting. Like if you are going to buy a pen, right? We purchased a pen or a stapler. These are some petty expenses, right? So to streamline and manage these frequent minor disbursements, businesses frequently appoint an individual specifically designated as a petty cashier. The role of the petty cashier is to handle and oversee these small-scale payments in a methodical manner. A petty cash book serves as a specialized accounting subsidiary where these minor day-to-day expenditures are meticulously recorded. This practice effectively segregates the smaller transaction from the main cash book, maintaining its focus on more substantial financial activities. So the term petty in this context signifies the relatively modest monetary value associated with these transactions. And the petty cashier is responsible for ensuring the accurate documentation of these smaller outlays. This includes managing the petty cash funds, disbursing cash as needed, and meticulously recording each transaction in the petty cash book. So, what we understood from this topic? That a petty cash book functions as a dedicated accounting record tailored for tracking and organizing routine minor expenses within a business. I hope this topic is clear to you all. That's it for this topic. Now go to our Telegram channel, access the notes, complete the notes, read it and learn the rules, perform the quizzes, do as many numericals as you can. So see you there. If you have any query, DM us on our Telegram group. So that's it. Bye bye.